We've talked a lot about the market recently. We haven't talked much about the overall economy and put that into numbers. I've downloaded some charts of the recent economic data just to give a level set of where we are. Big topic, I've been really involved in this, is home sales. Just because I'm buying a home first, number A. I'm trying to get a mortgage when I buy a home, and I've been just seeing that stuff go up like vertical. I would say a year ago it was like much closer to 3.5%, and now it's so high. You already bought your house, so you're good. You don't have to worry about this stuff. But it has had a direct impact, I think, in the last couple of months. You can see the rise there at the bottom, and the slowdown in existing home sales, and new homes being built. So housing starts is essentially houses that are starting to be built, and permits is a level before that, permits to the government, and all those are falling. Not from a historical point of view, it's not falling really quickly, but it's starting to fall, right? It's not the trend that used to be before.
This makes sense to me. Housing affordability is down, mortgage rates way up. I feel like everyone is talking about this particular point. I read from, there's a guy who writes a great blog that's super, super data driven. That's just housing stuff. I can't remember his name. It's just about home sales and things like this. The piece that was highlighted that I read most recently was about inventory. So inventory's up a lot month over month, but we're not even remotely close to 2019 inventory levels. Like inventory for sale is still very, very low. So this is happening. Sales are slowing down. I think homes are just sticky. Homes are a slow market. This is not the stock market. People do not reposition these quickly. These are slow transactions with a lot of transaction costs.
I looked at the transaction cost. If you're buying, you're committing to maybe like 3.5% of transaction cost. If you're selling, that goes up to, it could go up to like 7 or 8. The one thing that I think is missing in this graph is obviously home prices, right? Because you talked about affordability, and affordability equals like mortgage rate times home prices. And the home prices have gone up tremendously, and we don't have a graph today on that, and then you multiply that by the mortgage price going up, and you have vertical kind of growth in the mortgage cost. For someone who's earning a salary that $800 a month could make a big difference.
Oh yeah, anyone who's on the edge of any mortgage debt service coverage ratios,
that they're just being priced out of the market.
You just got, this is terrible news.
Yeah. And then the other part that I wanted to talk about, and I think we spoke about this in our last week, but if mortgage rates go up and I'm someone who wants to move up to a better home, I have a starter home, I'm thinking, hey, I want to sell it to buy a new one, but I realize that I'm going to pay, for a little bit better. I'm going to pay way more because I refinanced in 2021 at the lowest rate, or 2020 at the lowest rate possible. And now I have to buy something that's going to cost me, and interest rates are doubled since the lows. And on top of that, home prices have gone up a lot. I'm just not going to move. Like, I'm not going to be able to do that. And then if you look at the other way, the other source of houses is someone downgrading. Like, I retired, my kids are out of the house. Like, I don't need like 3 extra bedrooms. I only need like 1 extra bedroom for some guest or the office or whatever. And so if I have a house and I'm going to pay the same amount, when I downgrade, what's the point of downgrading, right? What's the point of moving? So I think there's an element of that, and that's going to restrict the amount of houses available, existing homes, I think, available. I really do think the beneficiaries of this kind of like frozen existing home sale market is the new home builders. Those are the only new houses that are going to come to market, I think. In an extreme case. The next one is business inventories, and this is kind of a weird graph here. You've seen like an increase in inventories, and my thesis here is like supply chains issues. The delay in supply chains has just forced businesses to carry more inventory, and now as a result, it's grown. But the big question is, what happens when supply chains resolve?
Talk to me about what's inside of this. What kind of inventories are we talking about? Everything? We're talking about clothes. We're talking about lumber at the.
It's retailers, wholesalers, and manufacturers.
But every business that can have inventory does and has much more than they had.
Yeah, I mean, it's
2 years ago.
growing. That's the trend, right? It's growing faster.
And inventory was something that, like, generally, as the just-in-time supply chain economy got into force, all the MBAs that graduated, their job was to keep inventory as low as possible.
The retailers push that first, right? The retailers say, like, I just want just in time, right? And so it forces the wholesalers to carry the inventory. And the wholesalers are like, well, no, I don't want to carry this. I want just in time too. And so then the manufacturer said, like, well, we have to carry some sort of inventory because, like, if something gets broken, we carry a little bit, but now we're not going to carry a lot because, our investors are demanding high returns on assets, high returns on invested capital. We don't want to have invested capital lying around there. So nobody had inventory. And then you have a broken, somebody had a strike, there was some stress in the system, and then things started falling apart. I don't know if you heard, but Target, in one of their, in the latest quarterly call, what they said was, hey, we misjudged like the kind of inventory we like. They have to order from the wholesalers, like, I want to buy this amount of inventory for this stuff. And so there were very long, like, furniture accessories and stuff like that. And that didn't end up selling very well because I think people are stopped buying new houses, or are stopping to buy new houses. And then also clothing, I think people had gotten a little bit chubbier during COVID, and so they had to buy new clothes, and they're returning to work, so they want to look good. They stopped doing that, and so they have excess clothes now, and so they have to liquidate this inventory at a lower cost, and but the inventory has been building up, right? So that's kind of like the story.
Makes sense. Do you think that this normalizes going forward?
Yes, I think it should. As supply chains start to get better and less fragile, I think these numbers should come down. The implications of that is that you're going to have an industrial slowdown because these inventories are built up through industrial activity. And if you have a company saying, "Hey, I'm ordering 100 now, next 4 months, I'm going to order 80 to get rid of my inventory," what that means is that at the end of the day, the wholesaler is going to get less orders, and the wholesaler will, send less orders to the manufacturer. The manufacturer ends up having to fire some people to still maintain profit margins and stuff like that. And so at the end of the day, you're going to have an industrial slowdown, I think. Next one, export prices are rising faster than import prices, and that's not good. That just it increases the deficit, like the trade deficit. And so the big question is, why is this happening? I have my theories. And my theory is that the strength of the dollar is forcing these import prices to go lower. If the dollar becomes stronger versus foreign currencies, what it means is that the foreign goods can come in cheaper, and in dollar terms, and as a result, they become more competitive. But the first order of implication is that from a dollar perspective, if your dollar is stronger against other currencies, that means that they can import stuff at lower prices. And inverse is the result of a stronger dollar. That's why they say, like, we want a strong dollar policy, sure, but that's really bad for exporters.
As I recall, a bit of a dying breed in the US.
You'd be surprised. Like, the big exporters are, yes, it's the small and medium manufacturer are going away, right? But the Honeywells, like the Illinois Tools Work, like the big Fortune 500 or like the S&P 500 companies, they're big exporters. Caterpillar and all these other companies, like, they export manufactured goods. Planes, like high value durable goods, they become significantly more expensive, and it becomes a problem. There's one more here: the initial jobless claims normalization. Like, look at this graph. This is actually raw numbers in the thousands, right? So 229,000 initial jobless claims. Our population has like pretty much doubled. I think, has it doubled, or it's up like 50% since the 90s or 2000. I think it's doubled since the 70s. And our initial jobless claims are So low.
The COVID surge is obviously ridiculous, but that slow climb downwards, just that march downwards of rehiring everyone post Great Financial Crisis is just wild. That 2009 forward graphs, just that low, steady slope of everybody getting back to work. It's pretty wild.
You might think that, okay, well, we fired like 50 million people. We have to rehire them. And as a result, initial jobless claims will actually be lower. And that gives us into the next one, which is like, the blue line on the top is job openings. The red line is continuing jobless claims. So how many people are unemployed? That delta, that difference between those two is kind of what's driving the bottom graph, which is wage growth, wage and salary growth.
How much is that number up on the bottom, that wage and salary growth?
I think it's year on year, right? So the last year on year change was 11.67%.
That's not insignificant. That's a pretty serious number.
Yeah. Then it would be great, but inflation is just, killing this number. If you had inflation of 2% and then a 12% salary growth, that would be great for.
What was the last year-over-year inflation reading? 8.5?
Yeah, 8.5 or 8.6, I forget.
I wanted to broadly compare stock options and RSUs from if we can do apples to apples, and it's not, these are definitely apples and oranges, but they're both equity compensation. And some people are ostensibly comparing two job offers, one of which has stock options, the other has RSUs. So maybe set just like a very high level framework on how we might compare the two.
Yeah. So if you're an employee, you're starting a new company and they offer you, hey, employee, do you want stock options or RSUs? This is like, if you get stock options, you get a grant of, let's say, 1,000 shares of incentive stock options. The grant price of that is equal to the fair market value. That's usually how it works. So let's say the fair market value is $100. So right now you got a grant for the next 4 years. It's vesting in 4 years of $10,000, right? If the company tells you, hey, Robinson, do you want, instead of the stock options, a grant of 1,000 shares, vesting the next 4 years? The obvious choice is the grant, right? Because I don't have to put down money to get money. Like that, the value of the grant, they're just giving me $10,000 there. And the other one, I had to put down $10,000 to own the shares.
That's the big high level difference that just has to be understood if you're ever comparing these two, which I think is a rare case. Like I've never heard of an employer asking an employee whether they want one or the other. Usually it's part of like a package you're putting together.
Well, usually you don't, you're not really able to negotiate that unless you're an executive, right? So.
Correct. So the big difference is you have to pay for stock options. And if you're not paying for them, you're going to pay for them out of the share price of your stock. So apples to apples, if you're going to make everything as equal as you can, the stock option will always be worth less than the RSU. Even though the options at equal values, right?
Okay. So then they say, okay, well, you know what? I'm going to double the stock option grant, because I recognize you're right. It's not equal. And so now I want to say, okay, now you're going to get, instead of 1,000 shares, you get 4,000 shares, 4 times the amount.
When you have a lot of upside and you're really bullish on the company, options are valuable when you couldn't get the shares otherwise, if that makes sense. Like if it's not possible outside of you being like a limited partner, in a very prestigious venture capital firm where you have access to maybe unicorns or like, fantastic upside startups, you can't get the equity of that 4,000 shares you just talked about unless you get it through your employment, right? It's not available in the open market. You cannot get it. So in that case, if your vision is, I want to own as much of this company as I can, right? And I want to get as long as I can, then that options package is pretty compelling, pretty appealing. It looks way, way different with mature companies, whether it's mature private or actual public companies. It's a totally, totally different ballgame.
If you are a private company, you get RSUs. you're having a tax event when they vest, because that's how they are taxed when they're vesting. So let's say they vested in 2022. Well, April 2023, you have to pay taxes on the amount of stock that vested. So you don't really have a choice. With options, at least you have a choice in terms of when the taxable event occurs, because it usually starts occurring when you exercise it. When you exercise incentive stock options, it usually hits your AMT first, and then when you sell it, it's another taxable event. That, in essence, is taken away if you're giving RSUs.
There's a Japanese company you probably know called Rakuten, the e-commerce company. Rakuten is publicly traded in Japan. They have a stock option program that is a 1 yen exercise price, and 1 yen is worth less than 1 US cent. So it's so you can get a package of non-qualified stock options, and the exercise price is 1 cent. So my question to you is, equal packages of RSUs and 1 yen non-qualified stock options, which one of those are you taking?
I would probably take the stock options.
Why?
Just because I have more control over the taxable event. That's it. Because the 1 yen, I mean, yeah, sure, you still have to pay for the option, but it's de minimis. But I get control.
That's right. I totally agree with you. I think that the counterintuitive thing is that these function almost exactly like RSUs from a tax and delivery standpoint. RSUs are like a zero cost option that is forced upon you. It's not an option. It's just like, boom, you have to,
quote.
it's exercised.
That's a really
done.
good. Yeah, that's essentially a very good way of explaining it. It's similar to a zero cost option. Non-qualified stock option.
So Yep, that's also forced on you, right? No choice on vesting. Whereas the 1 yen program, at the very least, you could build these up. Say you're an employee there for 6 or 7 years, and you have specific tax years that you'd really like to exercise in, or you have a view on the stock price. That amount of control is worth something.
Yeah. So usually, like, companies don't give you the grant value and the strike price, or the grant strike price. That's the same thing, but the strike price and the value of the share have to be equal. Like, that's for US law, statutory law, especially in the incentive stock options world. So if they're different when you exercise, that would be like income, I think it is, or like when it's given to you. I forget what it is, but there's a reason why that's not done.
I don't know what the exact reason is, but yes, frequently the fair market value of the shares and the strike price are the same, especially in early stage startups.
That's why you'll never have that case, I think, in the US, where you're going to have a 1 cent incentive stock option
strike price. In that case, again, going back to like the core, hey, options or RSUs, if you can get a bigger options package and you really want to get your paws on that equity, go for it.
Yeah,
take that bigger
I think
package.
the primary input of this analysis ends up being, okay, where do you think the price will be in 4 years?
Yeah, where do you see the future of this company is the most important question you can answer.
Incentive stock options, better tax treatment than RSUs, yes or no, in your opinion?
Yes.
Yeah, the exercise is an AMT event, but sometimes you don't need to pay extra taxes.
I will say this: better tax treatment, yes. Sometimes for clients, in my experience, they don't actually feel that, because when you're doing the analysis and you see that an ISO, in general, is usually going to have 2 different taxable events. So clients feel like they're getting taxed twice, even though the net number is better than being taxed as income. If you say, okay, we got a budget for the AMT during this exercise, then we got to wait a year, and then we'll probably have to pay a capital gain depending on where we sell it at. They're like, first of all, it's confusing. It's a headache. Like, wait, what? I have to wait how long and do what things? And it's according to what law? Jesus, this is complicated. And then the second piece is that there are 2 different taxable events, and people really feel like they're getting taxed twice on that. Whereas RSUs, at the very least, there's something straightforward about it. It's a zero cost. There's no exercise cost. Am I keeping it or am I selling it? What are we doing here?
Yeah.